Okay, I wanted to cover something a little more deeper with this video, just to make sure that we had good understanding before we proceed into next Thursday. This is an example. I'm going to have two examples that I'm going to show you. Example number one is, again, in the perpetual system. Okay, in the perpetual system, we are booking a purchase of merchandise, otherwise known as inventory, that costs $500. What you see here is that we're going to set it up. There we go. We're going to set it up as inventory, because when we do a perpetual system, we actually hit the inventory account. Okay, we directly hit the inventory account, uh, and what we'll do is we'll debit inventory for $500 because $500 worth of inventory is being purchased. And here you show a payable. Now, it could be cash. We're not going to get into that right now, but in this case, we're going to owe it. Now, what I'm going to show you, the second half of example one here is where we return it. So here they have the journal entry to record a purchase return of that exact same merchandise. When we say the same merchandise, we're talking about this transaction right here of 500. Let's go ahead and return it. What you notice is that what we do is reverse the exact entry under perpetual inventory system. Perpetual inventory system hits the inventory account directly. So here we'll show it. This is where we set it up, and here you see it as a debit, an asset, and then we show the receivable, the payable. And then here you show the inventory account being dropped by 500, and we're taking the $500 worth of payable off the books. We no longer owe that because we're returning this. And this again assumes a legitimate return for a reason, all that good stuff. Maybe it's damaged, whatever. Let's look at example 2. This is a journal entry to record a purchase of $1,000 of merchandise as follows. Again, in this case, we're going to have inventory for 1,000 because we're purchasing it. And again, notice we're hitting the accounts payable account, so we're going to owe it in the next 30 days or so. And this is a direct purchase of it. This is a very common entry to inventory that you would see in a perpetual inventory system. Now let's go ahead and pay for it, but instead of just paying for it directly, instead of debiting the accounts payable for 1,000 and crediting cash, paying for it, let's go ahead and take the discount. Okay. Notice that the discount is 2 within 10 days, and then net after that. In other words, you have to notice that with between 10 days and 30 days, you owe the full amount. Okay, there is no discount between 10 and 20. It's the only discount that exists is between inside of that 10-day period. We have to get rid of that. So we're going to pay this within 10 days. Notice how it strategically says within 10 days. So you know there's going to be a 2% discount. Okay, right off the bat, accounts payable, we need to take the full payable off the books. Okay, we're not going to pay the full amount because we're going to take a discount, but it's important that we take the payable off the books. It's important we take this entry off the books. Whoop, I'm going to spin here. Excuse that. It's important that this entry that we made for $1,000 to accounts payable be taken off the books. So now we're going to take the discount. You'll notice that the full 1,000 is taken off because we no longer owe that. I mean, at the end of this event, we no longer owe the 1,000. We're going to take inventory for $1,000 times 2% off the books. Notice that if we had left this alone, right, going backwards here, we would have inventory of $1,000. That's not really true. We no longer own $1,000 worth of inventory because we took a discount. What that means is we have less money in the inventory. So we're going to lower inventory slightly for the $20, and then of course the difference is cash. Okay, because that's what we're going. That's the benefit we're getting, right? We're getting the benefit of the difference between the 1,000 and the 980. To look at this another way, if it makes you, sometimes when you look at a problem different ways, it's easier to kind of deal with it. A different way to look at this is that this is a 2% discount. That means we're going to be out of cash 98%. 98% of 1,000 is 980, so your cash entry out of pocket, 2 minus 100 is 98%, is a cash entry of 980. The accounts payable has to come off the books. We no longer owe it after this transaction. And then the difference is inventory. So now inventory drops between the 20. We had booked a 1,000 debit before. Let's back up. We booked 1,000 before, and now we're going to back out 20. And when we back out that 20, what we're going to have in inventory account is 980. You will notice strategically that what we have in inventory happens to match cash, right? Well, matches cash because that's what we're actually out. That's how much we actually owed and paid for inventory. Of course, this ignores shipping, this ignores insurance, this ignores these other things we talked about. This is a simplistic inventory entry. But the key thing I want you to take away from this perpetual inventory system is notice how it directly hits the inventory account. There is not anything called a purchases account. When we look at periodic, periodic is going to have a purchases account, and it's going to have it's not going to have per se an inventory account, because what we're going to do is we're going to calculate how we're going to back into what inventory is at the end of the cycle, whether it's quarterly or annually or whatever. I wanted to show you this just so you got a second look at it, and I hope you found this these two examples useful.